Okay, thank you. So today's topics are three. Number one is why traders fail and succeed. Another one is mountain a trader must climb. And the third one is technical analysis of the stock. So I've selected few stocks. I'll show you the chart. So these two topics, the first two topics are very important to understand for all of us, why some traders fail and succeed and what are the hurdles. There is a big mountain for a trader to climb, and those who are starting out, they don't understand. The traders don't understand what they are up against, and they just want to trade and make money. It's not easy. If it's that easy, then everybody will be trading. When I tell people I trade for a living, they look at me and they ask me questions. Oh, very exciting. You're interesting. You're amusing. Tell me how I can make money. So it's not that easy. To make money. Trading is the hardest profession to make easy dollar. So, but once you need to understand what the mountain you're facing. So I'll show you the mountain and discuss. All right. So let's begin. So once again, trading is the hardest way to make easy dollar. Once we understand how to trade, make money, then the money comes easily every day, or at least every week. So for some traders, they go with the flow. They are confident. They are patient. They make money. Some are always frustrated, tweaking their system, modifying their system, abandoning the system, chasing the indicators, chasing the hard market or hard stocks. That's not the experts do. So trading is the hardest way to make easy dollar. Now here's the graph I found, statistics. So look at this pie chart. Failed traders. 70% of traders fail when they start. 70% of them fail. So I think we all know that. 18.5% of traders break even. So they break even even after several years of trading. They spend time, they spend money, they quit their job, and at the end result is they break even. So break even is actually called winning, but break even at what cost? If I broke even after 3 years and I sacrificed my salary of $150,000 a year, then I gave up $450,000. Maybe in 3 years my salary had gone up, so I lost $500,000, and I ended up break even. So, but it's still not bad. So only 11.5% traders succeed, and they go on to become successful traders. Some become rich, wealthy, some make a living, some grow their portfolio at a reasonable rate, beating the market. So at least 11.5%. So these are the traders who understand what it takes to become a successful trader. These traders, they really don't understand. They want to go all in. They ask questions on Facebook. Give me a stock where I can make money. Give me one stock where I can put all my money. If I have $1 million, which stock should I put my money in? Or I have $500. Guys, can you suggest a stock where I can put my money, my $500? So all those traders, they are they will go into this category because they don't understand. They hear all the traders making money, or in the news media and hot stock, latest IPO, and someone tells them I made money. Someone tells them I made $50,000 in last, suppose in one stock. That person is not telling that he had lost $100,000 before. Now he made $50,000. So he's not telling the true story. So the other traders just want to become like him and fail. So trading is not that easy, but it can be if you follow the system. So why traders fail? these are the main reasons for their failure. These are the main reasons for failure. The poor money management. So the poor money management means they don't know, they don't control their risk, they don't know how much to put in their trade, what is the market condition, how many positions they have open, what risk they should be taking, where is their stop, where is their exit. Anybody can buy a stock, but they don't know where to exit. So and they don't know how much to put in each trade. So it requires it's a science. So this poor money management, this area is a science where people fail. They don't understand. They just buy based on some news or somebody tells them, and then that's it. They have gambler's fallacy. So give me one star where I put all my money in. So that's what they do. Put their money in, they wipe out their account. And another thing is they open their account with like $2,000, and then they wipe out. Then they go back and they get another $2,000, and then they want to get their $2,000 back. So they put another $2,000 in next hot stock in order to double their money, and then they lose again, and then they go back. So this is they double down on when they lose, they double down. Instead of reducing the risk, they go up, they go all in. So this is bad. Lack of discipline. They don't have any discipline. They are chasing this is stock, that stock. They don't have any technical analysis. They don't understand fundamental analysis. They don't understand the market. They just get in, get out, make few bucks here, few bucks there, then lose big. They don't have any lack of they lack guidance. So they have not either studied themselves, or they don't have anyone to guide them. They are on their own. So when I started, I was on my own, and I completely wiped out my immediately in a month. I wiped out my $2,000 account I opened way back. I thought I'm gonna make money with $2,000, and I wiped out. So there was no guidance. Then I realized that I need to study this. It's not that easy. So they lack guidance. They have no guidance, and they lack experience. Just because they trade for a few months, so someone says, I have been trading for 3 months, or I've been trading for 6 months. That's 3 months, 6 months is nothing. You need at least, in order to have a graph, 10,000 hours in any field. So they don't have experience. They don't put hours, and they want to make money. So when you combine all that, the traders fail, and they fall into that 70% category, which is not good. So their money is taken by the professionals. So professionals take their money, and I mean, traders need to pay attention to all this. And why the traders succeed? Because they have put time into it. They have developed the system. They have studied the market. They have a trading plan. They have a trading system. They have gone through various cycles of the market, so they understand what the market is doing and what the market can do. So they have put in the time, and they have knowledge, and they have experience, either simulation experience. They have tested their system on a simulated mode, and then they go slow. When they go live, they go slow, and then at the back they have guidance. So somebody is guiding them. They have mentor. So this is where they lack. If they don't have any, if they get stuck, nobody is there to guide them. They don't know. First of all, they don't know why they are failing. They think the reason they are failing is something else, and they think something else. That's why they are failing. It could be another reason, and they don't know why they are failing. And then since they don't have any guidance, so they never figure it out why they are failing. So putting the time, knowledge, acquiring knowledge, either reading books, researching on internet, having a mentor, and then and building the experience, first in a simulated mode, then in a live trading, because no matter how much you do in a simulation, real-time trading is something else, because of the emotions get involved. When you're trading in a simulation mode, there's no emotions. So it is also important that when traders trading, they can record their emotions on a daily basis. So I'm developing a little software where click of a button, you can record the emotions, what emotion you felt. So were you feeling good today? Depressed, anxiety, tense, what kind of emotion you had? You click the button, you record it, and then you get the result of your emotions over the period of 1 month, 2 months. And then you see your graph, what emotions you went through as the trading goes by every day. And then what was your result? And what was the market what was the market doing at that time, and you were going through that emotion. So so live trading is different than simulation, but you have to do some simulation before you go in. So the failed traders don't do any of this. They just jump in and they go through all this. They don't. This is a biggest problem here. Poor money management, gambler. They are all gamblers. All right. So next, now this is the mountain a trader must climb. They are not aware of this mountain. So this is a big mountain. When the trader reach this top of the mountain, that's where they see the consistent return. They start right here, so they don't know what they are facing. And I'll explain the 5 C's of a mountain: capitalization and commitment, capital conservation, competence, confidence, and then consistent returns. So let's go through these factors one by one and see what they are. So the first thing is capitalization and commitment. Um, every trader needs to take their own personal responsibility. Not when they are trading, they need to take responsibility for their own action. Every day, whatever mistakes they commit, they need to own it. Secondly, they need to know what kind of mistakes they are committing every day, and how much it's costing them. So they need to be personally responsible, and they need to. I think I did not write the bullet capitalization. One thing in capitalization is that they need to have a bigger account size. This game is trading is not for the guys like having a $200 account, a $2,000 account, or $4,000 account. This is not for those who have a low capital. This trading is for people who have a good net worth, have a salary, don't depend their income in the beginning. They don't depend on making money from trading, and have a large size. 50,000 and above is a good amount. So minimum 30,000. So adequate capital, and then commitment. So adequate capital, they lack, and then they lack capital. They don't they lack commitment. So they are not committed. On a scale of 1 to 10, suppose if I ask how committed are you, some say I'm committed 9, some say I'm committed 10, some 4, 5. Even when they are saying 9, they are actually not 9. They're just saying it right now. When the time comes to really learn something and do something about it, their commitment is like 4 level, 5 level. So on a scale of 1 to 10, they need to have a commitment of 10. Otherwise, it's not going to work. And yeah, here is a point: capital to withhold losing period. So the way the system is designed, that your system is designed that even if you lose um, consecutively in trades, you should be able to stand in the market. And the way you can stand is, first of all, you begin your trading knowing how much you're risking. controlling your risk. And then you have a larger capital size to withhold the losing period, because you know that based on your experience and what you have developed your system, that after a losing period there will be a winning period, and then when the winning period comes, then the profit will come eventually. And when you're losing less. So if you're losing, suppose you lose 3, 4, 5 in a row, those trades, and then you start winning. The winning should be in 2 or 3 trades, or you cover all your losses and then you move forward. So let's say if you start with $100,000 and immediately you see 99,000, and then you see 98,000, and then 97,500. Then you go back 98,000. Then you go back to 100,000. Then you should see 101,000. Then you suppose come back to 99. Then you see 103, 105, 107. So you are going up. I'll show you what kind of equity curve you should have ideally. So capital to withhold losing period, and you have a system to bear this losing period. And another thing is they should be able to trade multiple markets. By markets, I mean various indices you can trade, various stocks you can trade, not putting all your money in one and or very few stocks. Some they just trade, they put all their money in one stock, and they try, and when that stock goes against them, they see big red, and they cannot take it. So when they cannot take it, they just exit, and when they exit, and that's where when the market moves in their favor, but they are not in that market. So this is another key. Another thing is trading multiple contracts. So successful traders, they trade multiple contracts. They don't trade one contract. And the reason is, or multiple contracts, or you can say multiple lots of shares also. So for instance, if your system is telling you can buy 500 shares, you don't buy 500 shares right away. You may buy 200, and then another 200, then 100. Or if you're buying options, and you should be able to scale in and scale out. 2 contracts, then another 1, then another 3, and then you get out. So all this plays role. Traders don't realize, they just jump in with all. Either they have money for one contract, or they don't have any money. And when they buy one contract, and that's it, they sit on it. If they're losing, they're losing, and the stock eventually bounce back up, goes in their direction, but they don't have money to add. So trade multiple contracts. So this is the first mountain they need to climb, first layer of the mountain. So capitalization and commitment, very important. Educate, right? That's the word. Sufficient capital they should have. Now, the second layer of the mountain is the capital conservation. So capital conservation is the priority than the capital appreciation. So when we put the trade, we need to know, okay, I need to first, how I make sure that I don't lose, or if I lose less. So that's very important. So let's say you bought 500 shares, you put 200 shares, you put the target. Let's suppose you put the target for 200, and then another 300 you have a target for a higher target. But when you make 200, when you suppose you sold those 200 at the first target, now you have 300. When the stock moving down, you should lose less or come out at break even, because you made money on those 200 shares, and then you have only 300 shares left. Now the market is going down, or the stock is going down. So you try to conserve your capital rather than holding that 300 shares for gain, and then it doesn't come. So capital appreciation is a secondary. Capital conservation is a priority for the trader. And again, sound money management principles, so which is an science. You need to develop the system to. So anytime you're in the market, you should know what's your risk, where are your stops. So I have developed something, and I monitor it, and I say, okay, this is my risk. per day. So, and if all hell broke loose, this is how much I will lose of my capital. So if I'm happy with that, if I know that okay, I'm willing to lose this much capital, it's fine. And then on the other hand, I know what I'm aiming for in terms of gain. So this is what I expect to make, and this is all hell break loose, or when the shit hit the fan, how much I'm going to lose. So you should know on everyday basis. You should be able to know that. So capital conservation is the key. Third is competency. So uh, every trader need to be competent in his game, otherwise you cannot survive. And all traders have different they have their competency, different competency. So for instance, some are swing trader, they're good into it. Some are day trader, they like day trading. Some are long-term investors. And what are their objectives? So they need to understand their own personality. For instance, for me, I am a swing trader. If stock give me a gain the same day what I'm expecting, then my swing trading becomes a day trading. But um, I don't start as a day trader. So I don't start as a day trader. I start as a swing trader or a long-term investor. So my style, my objective. A lot of my members, they like my style. They say, "Oh, my style matches your style, and I have the same objective." So they have a good relationship with me. But whereas the other trader who, first of all, their style is different than my style. They want to close the trade the same day. That's not my objective. They don't implement the proper risk control or money management. So they put in all the money in one trade. So if that trade is losing money, they don't have any money to put on another trade, or cannot average down, or cannot manage, then they don't match my style and my objective. So so it's different traders, different objective. They need to understand their own preferences. So again, based on the trading preferences, they need to develop their trading plan. So what is the objective? What they're trying to accomplish? Whether they're swing trader, day trader, scalper, long-term trader, investor, what they are. And so they mix things. They have a same account for one account for everything. They trade stock in their same account. They trade option in their same account. They are day trading in their account. They are swing trader. They are holding the stocks in the same account. Everything is in the same account. That's mumbo jumbo. So so they don't have a plan. Different objectives, different types of trading account. They don't have grip on the market. They don't have a grip on the analysis. They don't know what the stock is doing, what they should look for. When the stock goes against, they don't know whether they should exit or hold or put more money. They don't know. They have no idea. So, and they cannot execute. And another thing is the trading process implemented smoothly. So every day they should implement they have developed the system, and then they go when the market every day, like in the morning, when 1 hour, 1.5 hour before the market opens, I come to my office, I turn on all my computers, see everything, and then I have a system. So I follow a system. Okay, I need to do this. I need to see my pre-market. Okay, I need to see what's going on with this stock, which stock I should monitor, uh, when the market open, which stock is moving after half hour or after 1 hour, what I should be doing. So I have developed a system, and then I just follow that system. So every day is the same thing. It becomes boring. Sometimes I just sit and do something else while the market is doing nothing. So this needs to be implemented smoothly and effortlessly. Every day is like that. Now, once you go through the higher level, then you build the confidence. So the confidence comes with having a belief in your system, because you have developed a system which gives you return. So you're supremely confident about your ability. So this is where the higher level, you're reaching at the higher level of the mountain. And when the losing period comes, you're not surprised because you have a high belief in your system. You know that things will turn around, and the market is difficult or challenging. So market has various mode. Sometimes market is very favorable, sometimes it's difficult, sometimes it's very challenging. So if you understand it's difficult and challenging and having a losing period, but you have a confidence and you're patient and persistent, the thing will work. And another, optimistic and positive attitude. So this some traders, they are always have a negative. Is their personality or whatever it is, they are always negatively thinking. So maybe they are not only negative in the trading, but in their generally in their life, they have a negative. If anything goes wrong, they just freak out instead of fixing things. And then what happened? They don't stick with their trading strategy, so they jump around. They follow this strategy, then they follow that strategy, and they abandon the system. They follow another indicator. They look for another system. So all this is messed up. So because they don't have a system, and when they have a system, they constantly review, upgrade, and improve. So whenever I miss a trade, a good trade, then I say, okay, why did I miss it? Or if I miss a profit, why did I miss the profit? Or if I'm losing big, why I'm losing big on this one? So all this constantly you need to review, upgrade, and improve. So constantly this is the loop. So it's like a loop. So you go through, right? And then at the end is the consistent return. So now, consistent return. Some traders have a consistent objective that every day they want to make, suppose, $1,000 a day. That's their objective. But they don't force themselves to make that $1,000. If there's no $1,000 today, it will come tomorrow. But they have a system. They know that, okay, today I did not make 1,000. Suppose they made 500. Tomorrow they may make 1,500. On the overall, in a weekly, week-to-week basis, they are aiming for consistent return and not aiming for singles rather than home run. Home run comes once in a while, but it's the singles. So constantly implementing the exit strategies. This is very important. Exit strategies. What are your exit strategy? Where are you going to exit, and how much you will exit as the stock moves up? How are you going to manage that trade? So this is important. You can enter a right trade, right stock at the right time, but then you don't have exit strategy, and that's where you give up the profit, and the winner become a loser. So what is your exit strategy? How, when the trade is moving in your favor, how you are monitoring it? So the way you monitor, it should be like automatic monitoring, is on autopilot. So ideally, once you enter the trade, your trade is on autopilot. In other words, you shut down your computer after you enter, and you put on your strategy for exiting. You don't have to look at it. Suppose that's the only thing, suppose one stock, and you put the exit, or even 10 stocks. You can take a look after 1 week, and you should see what happened based on your exit strategy. So unless something drastic happened and the stock gap down or gap worse, you will get the worst fill. But if nothing drastic happened, the stock should follow your exit strategy, and you should be getting out. So, and then you should see a smooth and rising equity curve. So this is important, smooth and rising equity curve. And I show you the curve. The ideal curve, it should look like on a rising on a 45-degree angle. And how if this requires, this is, nobody can achieve this, but this is like hypothetical ideal equity curve rising smoothly. The curve and this is what's happening is that you have a minimum intraday drawdown. You have end of day minimum possible drawdown. There is no big um, uh, difference every day, that one day you have a 30% drawdown, and another one you gain 30%. So it means something is wrong with the system. Every day on in an ideal world, your equity is rising and it's rising on a smooth basis. People want to chase and make their equity curve go like on a 90-degree angle, and then it comes down like that too. So I prefer my equity curve rising slow, but smoothly, because people don't realize this. If you make 0.5% on a portfolio a day, 0.5%, which is 2.5% a week, which comes to 100, more than 100% a year. So slow and steady and gradual can give you 100% return. If not 100%, suppose you make mistakes, trade, let's say not make 100%, 50% return. 50% return compounded, you will be rich. But what happened is traders look for immediate gain, and then one day is big gain, another one is loser, then third day is big gain, then the fourth and fifth and sixth is a big loser. So consistent return is the key. All right. Yeah. So before I move on to the next topic, I just want to let you know I have a 7-month Mastering the Market coaching program. If you're interested, we can talk for 75 minutes. Send me the email and I'll send you the details. All right. And if you want to do swing trading, if you're not my member of swing trading, you can take a trial for $27 for 14 days, and then you pay just the regular price. And the next webinar will be probably next Sunday, Monday. I'm not sure. So, but it will be at 5 p.m. So I'll show you another topic. Just a second. Let me open another slide. Okay. So we go on a stock. I found some stocks and I show you the chart, and you can put it on radar or whatever you want to do. So this one I found was on Friday, AOS. So this is just on my radar, and I will see what it does on tomorrow. And the reason I'm putting it on radar is because when this is at support, so when I go back on the left, I see that it bounces. It bounces at 60 level. So you see it bounce from here, 60 level here, 60 level here. It bounces 60 level here. Here is bounce. Then here is bounce. Then another one. And then so if the stock bounce back from 60 level, then there's a chance that it can bounce again. So I just want to put it on my radar. So anytime the stock bounce from the support 3 times or more, it's a valid support. And here also, look at this. It moved down, but then it bounced back up. See this big move up, 60 level. So if the stock did it before, it can do again. So I just want to put it on my radar. Another one is APC. So APC gapped up and gap above the resistance. So I said, I need to watch this stop. So when I draw the support line, it bounced from the support line and it gapped up. So now, and it gapped up, you see it gapped up above the resistance level at 72. So I wanted to it to come down and test this support, because this was resistance, now it's support. So I wanted to come back to 72 level, and even if it dips below, that would be ideal for entry. So need just a pullback and then go back up. Baba. So Baba is my favorite. I trade Baba, and the reason I put it on 20th of June because of this hammer. So I said, oh, hammer, 200 is a solid support. So right now it's trading at, I think it's trading right here. This chart was made on 20th, so on 22nd. So it's trading right here. So I have it on my watch list. So I prepare my watch list and then I watch it separate than other stocks. So I said, okay, I need to watch Baba. So Baba, I think is trading right here, 202 to 201. So it pulled back. So next run up, I'll get in. Next one is CELG. So you see CELG is doing its thing. It is when the stock make a lot of these type of small candles, after a fall, the chances are that the stock is expected to move up. So CELG is expected to move back above towards 83. So keep it on radar. Here CMG. So you see CMG, this CMG after gapping up never looked back. It just kept going up and up. Now it's facing this 480. I don't trade CMG often. It's an expensive stock, but I just want to show you the chart, what I'm seeing here. So CMG, if it crosses 480, it will be a new move up. So CMG is on radar. It's just touching the line and it's kind of facing the resistance. But if the resistance is broken to the upside, then it will continue next up move. So CMG is on the radar. CNQ, so another one gapped up from the bottom. So when the stock gaps above from the bottom, it's a beginning of a new trend. So it's the beginning of a new trend. So it's just clearly telling us that I want to go up. Look at this gap. See, it gapped down, it gap up. When the stock gaps down and then gaps up next day, that's another indication that it wants to go up. So otherwise, why the stock gaps down then gap up? What's the reason? Why? So it gapped up here and it's telling me that the stock gaps up, down, and then the same day it got bought. So you see there was a volume climax. So gap down, move back up, then second day gap up. So so this was the entry right here, and then gap up continues. So again, same here, gapped up, and this candle is very bullish candle. So we may not see a pullback. We may see continuation to the upside. Another one is COOP. So COOP also gap up and cross the 50-day moving average. So it's sitting in the 50-day moving average, so it's on radar for entry. Another one is CRM. So CRM was doing fine till, so I prepared this chart on 14. CRM was doing fine, it broke out, and then it pulled back on Friday. I think it pulled back. I don't have its chart for Friday. I prepared on 14, then I forgot to prepare. So it's sitting right here somewhere. So it's good. So if it holds this line, this resistance line, and then you see the reversal, that's the new entry. So CRM, you can put it on radar. Now I want to show you this DLTR. This kind of chart never hardly fails. It's a super bullish pattern. When the stock gaps down, goes on the sideway, and then it moves up. It's a brand new move, and usually the chances are that the gap will get filled. So I went long into it, and we made a 200 per contract. This was a huge move on 12th of June. Somewhere we enter here in the middle. I don't know if we enter here or somewhere in the middle here, and then we exited when it came close to the resistance line. And the reason we exit because of the swing trader. So I know I'm a swing trader. So if I'm a swing trader, I will look for the profit. 3-4 continuous up move days, I take profit. So I'm not a long-term, especially in option, I'm not a long-term trader that I just hold it. If I have a long-term portfolio, I would hold for this gap to fill. But since I'm a swing trader, so I exited already. This one DVN, I just want to show you the chart. I don't have any portfolio, I mean any stock in this or any holding. It's from support, it gap up. So all the energy stocks recently gap up. Most of them they gapped up. So all the crude stocks. So this stock, when DVN pulls back towards 42, it will be an entry for me. Just to make sure pullback is needed towards 42. Another one is Goldman Sachs. So Goldman Sachs has a strong support at 225 and 226. So if you look back here, all the way here, you see the support. And you see the support here. Here you see the support. And again, same thing. Here's the support. So Goldman Sachs should be on the radar to go up. If the financials move, then this move. go up. So just keep it on radar. HES, HES was, I think, was sent to end of day service. I did not send in option trading, and I had some shares in also in HES. And this is what I saw. So crude move when the stock gaps up from the support, it tells you something that I want to go up. So gapping up from the support means buy me. So I bought on this day, and then when the stock gaps up, it usually comes down to fill the gap. So that and that is the support. So this area is the support because it gapped up from here. So this is what happened. Gap got filled right here, and then gap up again. I had 650 shares on it. So I bought it here, 62 something, sold it here. My entry was just based on the gap from the support. So gap up, pull back, then gap up. Then I did not exit on this pullback because I know this is the support. So I shouldn't be exiting. And my stop was below this. So 650 shares was bought based on how much I'm going to lose, what would is the risk based on my portfolio size, how many positions I have opened, all that and taken into consideration. So my calculation came to 650 shares. So it came like 645. So it came from 645, I rounded to 650. I did not round to 700 because that's I shouldn't be doing it. So my system saying so you buy 650 shares, 645 shares. So I rounded to 650. So I bought 650 shares and then sold it on this uh, gap up because back to back gap. So I want to make sure I lock my profit. Yeah, same chart. Okay. Now KMX. So you see KMX, when we see this chart like this, right now we don't know what KMX will do because it gapped up right here, then pull back and solid support. So unless you caught the move here on a pullback, um, you need to keep it on radar. So another pullback and then reversal to the upside because this is way too high. But I just want to show you how the stock from here, it closed here, it gapped here, right here, then moved up all the way here, came down and then went up and then closed here. So right now it's kind of in a la la land. We don't know what it will do, but it's a bullish. So I just wanted for it to pull back and then go back. I mean, I will see the entry if I can time the entry for it to go back up after pulling back. MasterCard is on radar. You can see it's trying to move up, not down. So another little slight gap up. This was a bullish candle, and then this is another bullish, and then the gap, slight gap. It's not a big gap, but it's a slight gap, and it happened on 20th June. So I'm just keeping it on radar. Keep it on radar for long, and the way you can determine the target is you extend this line to the right side and see where it goes. So it could go to 27209, right? Okay, here, yeah. So this is the 22nd of June. So it's just still sitting on the side. MRO, again, another energy stock, gap up. So a lot of energy crude stocks gapped up. So need to watch your favorite. You can make a list of all your energy stock and see if you can time your entry in the crude stocks and go long. So I'm just showing you another one. See, when the stocks gapping up, all in the same category, it's telling us that they want to go up. Netflix, I gave the target Netflix 420 long time ago when it was trading way, I don't know where, maybe here somewhere. I had 425 target, so it's not far from 425. Now my target is 500. So Netflix is one stock which is the best among all the stocks I have in the portfolio or in the basket of 600. Netflix is the best one, and it can go to 500. So Netflix is the one which is super bullish, and this is kind of smoothie. Is you can I call it a smoothie This is a smoothie stock, which is constantly after this entry, it just keep going up and up and up and up and up and up. You see, up and up and up. It's just riding this trend line. And this chart was prepared on 13th June. Okay, so on the 20th of June, another break, and it's sitting at 412. And I don't know what it did on. Okay, now it's 411. On Friday, it closed at 411. So first target is 425, and I somewhere here I don't remember the date. Now it's 500. So Netflix is going to 500. Thought is another one. I just want to show you the chart. Again, it's gap up from support, and I wanted for it to pull back. When it pulls back and then go up, then I'll go long. So it's just sitting under the 50-day moving average, just on radar. Another one is Twitter. Twitter, I gave the target of 50. It's very close to 50. So in the end of day service, the target is 50, and now it's sitting at 46, 47. So it's going to 50. Another one, the stock which is going to 50 is JD, and 50. And another one, AMD. AMD is very strong. Right now it's pulled back. It will go to 19. So AMD is a $19 stock. Twitter is $50. Now it's very close to 50. So $50, almost there. JD send the alert on when it was 40, it's going to 50. So Twitter, JD, AMD, Netflix, these are the stocks. WLO, again, energy stock. I just want to show you, see another gap up. So all these energy stocks are gapping up. So just need a pullback. Win Resort, Win looks like it's bottoming right now, and I have it on radar. It's based on this support area. So Win looks like going up. Here's the support. So you can keep it on radar. X also is in a tight area, and it can break up. So it looks like it wants to go up based on these three candles, and it's sitting right at congestion area. So X, once it breaks 37, 38, it can start moving up. So you can keep X on radar. It looks like it wants to go up, not down. Okay, so this is the chart of Hindu. There's nothing special. The Dow Jones is sitting at 50-day moving average. It's just sitting at 50-day moving average. It broke 50-day, then it went back up to 50-day. So it's just hugging 50-day moving average. SPX pullback is also, it's not that strong. The market is not that strong. Again, pullback. So I just prepared the chart. What's going on? So it's nothing to say that this is definitely this, it will do this. So don't know. Again, NASDAQ has a support right here, 7,100. Gapped up, sitting at 7,200, 7,197. So I show you NASDAQ. NASDAQ has support at 7,100 level, NASDAQ 100. All right. So this, Russell. So Russell 2000, I show you the chart. What Russell 2000 is doing is it's nothing to explain what's doing right now. This one, it broke out and pulled back. Now it's just another slight pullback. So this candle in Russell 2000 is telling me, because the combination of these two telling me the market wants to go up, but right now it's in a choppy mode. So last 2-3 days, the market is in a choppy mode. So the strength is not good enough. All right. Again, I have a 7-month Mastering the Market coaching program. If you're interested, please send me an email. We'll talk for 75 minutes. All right. And if you have any questions, please send me an email, and I will reply to your email. Thank you. And if you want a swing option service for $27, again, send me an email, and I'll send you the link for PayPal. And you can, or you receive email tomorrow, maybe in the morning. So look for the email. It will have a PayPal link. And if you're not a member, you can take the trial. And if you have taken the trial before, then it's not valid, only valid for new people. So thank you very much for coming, and I'll see you when I see you. Thank you. Bye.